In today's webinar, we'll be talking about safeguarding end user funds, which is one of the key requirements under the Retail Payment Activity Act. With the September 8th deadline coming up, we know many PSPs are weighing their options when it comes to safeguarding. So today we've brought together legal and insurance experts to talk about those options and what PSPs should keep in mind as they prepare for compliance. So the webinar is going to start with a Q&A style discussion with our panelists, and then we'll open it up to questions from the audience. So feel free to jot down questions and be ready to ask them at the end of the webinar. And then with that said, I'm going to hand it off to you, Mert, first, and then to Simon for a quick round of introductions.
Sure. Thanks, Dana. Great to be here, and we're very excited for the friendship and relationship with Fintechs Canada. We represent Purves Redmond Limited. We're a Canadian independent insurance brokerage, so we focus on complicated, challenging areas of risk, and we're very focused and have a history and track record in tech and fintech and payment processors, and that's why we're so focused on the changes with the RPAA. Today, I have my very good friends and business partners, Sean and Cam. You can't see Sean; he's off camera for a moment, but Sean and I are very close business partners. Sean leads our fintech and tech practices and has a very strong portfolio and background and expertise in this area, and he's been working on the RPAA related issues and risks for well over a year. And my good friend here, Cam, who's also my business partner. Cam is our subject matter expert from a bonding and surety perspective, and that's one of PRL's strengths, is tremendous resources, in particular in bonding and surety. And we're lucky to have a good guy like Cam on the line and as part of the team. Thanks, Dana.
Simon, do you want to throw a little round?
Thanks, Dana. I'm Simon Grant, a partner at Bennett Jones. I'm in the Toronto office. We're Bennett Jones. We're a full service, also independent Canadian. Important to say that these days. Across the country, we have offices in addition to rainy Toronto. We're in Vancouver, Montreal, Calgary, and Edmonton. So all of the main business centers in Canada, we serve clients. I'm co-head of the banking group at Bennett Jones, and I'm also the co-head and co-founder of the Fintech group, which overlaps with the banking group, but is a distinct. I actually set up the Fintech group here at Bennett Jones about 10 years ago. So Fintech is a sector that we've had a long interest in. We serve clients in all aspects of the Fintech ecosystem, including payment services providers in Canada and ones outside Canada that are coming to do business here. And it's a pleasure to work with PRL and Fintechs Canada on the RPAA here.
Perfect. Thanks, Simon. So I think we can maybe start with the basics in terms of RPA and the regulatory landscape and why it matters. So Simon, I'm going to direct this question to you. So what is the RPA asking of PSPs when it comes to safeguarding end user funds? And why is this a requirement being introduced now?
Yeah, great questions, Dana. So first of all, why now? Well, I would say this has been a long time coming. Those of us in the fintech world in Canada, we've long been expecting this kind of regulation to come. I think we've all heard the arguments from the banks in particular, that there's a quote unquote need for a level playing field between banks and fintechs. I could argue for and against that argument, but the basic result is this legislation, the Retail Payment Activities Act, which of course applies to fintechs, not to banks. So I think in terms of what the key requirements are to understand, it's really critical to look from a high level at what the objectives are behind the RPAA, the stated objectives, and those are, number one, particularly from a safeguarding end user funds perspective. Number one is on the event of an insolvency of a payment services provider, the need for end user funds to be protected. That's priority, I would say, number one. And number two is that end users have fast and reliable access to those funds, both in an insolvency as well as in the ordinary course. Now, these are rules that apply in various degrees to banks already, I would say, but they're now being rolled out to apply to fintechs, of course, because as we all know, there's more and more roles for fintechs in the economy generally, and so there's a perceived need for end users' interest to be safeguarded in the same way that they would be if those funds were in a bank account. As you said, Dana, of course, this takes effect in September 8th, which is not now, it's not yet, but as all of us are going to detail here, there is a lot to comply with here. So I think we should all be, as I'm sure you are, keen on getting compliance up to speed as quickly as possible. In terms of what the RPA is specifically asking for from an end user funds safeguarding perspective, number one is that the end user funds need to be in a segregated account. Now, this is the case whether, and we'll go into this in more detail, whether that is subject to a insurance or surety product or whether it's in a trust. In either case, the funds need to be in a segregated account. Certain investments are permitted. The funds can be in, for example, GICs. There's a list of what's permitted and not stocks, not mortgage-backed securities. Effectively, they need to be cash equivalent, like liquid assets. Cash, of course, being one of them. So that's one requirement that's being asked of PMSBs. A second is there needs to be what is called a framework, and a framework encompasses a lot of different things. One is that there needs to be an end user ledger, for example, and that includes contact details of ultimate end users. There needs to be a liquidity plan, so a plan to get liquidity into the account, whether by way of a line of credit or through some other means. And finally, and critically, there needs to be an insolvency plan. Think of it like a living will, sort of. So that in the event that the payment services provider goes insolvent, there needs to be a stated plan for how end user funds are protected. Now, those all apply regardless of whether the funds are in a trust or in a insurance product. But that's the kind of fork in the road that we're looking at here, is that the funds can be either subject to an insurance or guarantee product, as Cam and the team will discuss here, or they can be subject to a trust.
No, thank you, Simon. I think with that we can kind of segue into our insurance experts and kind of talk about insurance products for safeguarding funds. So I'm going to hand it off to Sean and Cameron. So can you guys walk us through how a surety bond, a guarantee, or insurance policy work in practice? And essentially, what are the key differences between them with respect to the RPA, and why does it really matter?
Sure. Great question, Donna. And listen, I should say at the front of this is that the focus of what we're going to be talking about really is on the surety or guarantee product. But I know a lot of folks on this call will not be familiar with surety. So in my experience, to describe something best, it's often useful to compare it with something that it's not. So I will compare the two products. So an insurance policy is something that everyone on this call will be familiar with. Mm-hmm. That is a two-party agreement where an insurer agrees to pay out on claims once a policy trigger is met. So under a sort of narrow set of circumstances, like a shortfall, insurance policy could potentially pay out on behalf or to end users. Now, the reason why we are going to focus on surety for the duration of this call is that it is kind of emerged as the, let's say, preferred or more appropriate solution, given a couple different attributes, which we will dive into. But first and foremost, with comparing it to an insurance policy, a surety bond is a three-party agreement. Those three parties are the principal, the obligee, and the surety. And just to make things simple, the principal would be the PSP in this case, or those of you on this call. The obligee would be the end users, or via the Bank of Canada, And then the surety would be those insurance companies that we are all familiar with. So this is a three-party agreement where if the principal who owes an obligation, they have a duty to perform to the obligee. If they fail to live up to that promise, a surety is going to act as a backstop. So a common sort of use of a surety bond that we see throughout the Canadian landscape is in construction. A municipality wants to build a hospital. It does so with taxpayer funds. And if a contractor either fails to construct that hospital or walk off the job site, that's a disaster. Because again, not only are taxpayer funds going to waste, but now a township or municipality goes without that hospital. So a guarantee is used to ensure that that contract is completed. In the PSP case, this guarantee is being used to ensure that all end users are made whole in the event of an insolvency, which Simon touched on earlier. So that's the simplest way I can put it. It's a guarantee product. It's credit. It's not insurance. I'm happy to field questions after the call because, again, this is a product that's going to be new for the vast majority of you.
Yeah, and I'll step in as well and just talk about this a little bit more because we've spent quite a lot of time looking at whether or not an insurance product is actually proper and will satisfy the Bank of Canada and what it's asking for in this new regulatory regime. And after quite a lot of investigation and consultation with the Bank of Canada, as well as other stakeholders, we've come to the conclusion that as they stand now, an insurance policy just isn't going to work. And the reason I raise that is because in the regulations and in the statute itself, it makes specific reference to an insurance product or insurance and guarantee. And I know all the compliance people on this call are going to be going, yeah, they say insurance. Well, I don't think the Bank of Canada understands the difference between insurance and surety, just like most people in the world don't understand the difference between insurance and surety.
Very fair.
So for us, we have a professional obligation to make sure that we're not going to be making a product available to people that isn't going to stand up to audit scrutiny by the Bank of Canada and their enforcement division once this thing comes into play. So the reason why we're highlighting this difference is because a bond provides a guarantee, as Cam was just saying, a guarantee over the funds in the segregated account. An insurance policy will not. An insurance policy will end up providing coverage for a shortfall in that account, as we see it. And that is a fundamentally different type of coverage and one that we do not believe is going to satisfy the aims of the legislation and what the government is ultimately trying to accomplish with these incoming rules and requirements.
Yeah.
So that's why it matters, and that's why we're talking about it, and that's why we are totally at this point focused on a bond or a surety solution. And we're also confident that a surety solution is going to actually address the problem.
Yeah, as it's done in other jurisdictions. We are pulling a lot from other examples around the world, different jurisdictions that already have this type of legislation in force and where a surety product has been a proven solution.
No, amazing. Yeah, no, that's very interesting. I feel like we haven't really heard the word surety much when we talk about RPA, so that's great to know. Another thing we've heard questions about is CDIC insurance. So is that something PSPs could use to meet the RPA requirement, or how does it compare to the other options that we kind of touched on?
Yeah, this is also a great question. It is something that the Bank of Canada has answered directly, but it does bear repeating here. CDIC will not, or is not viewed as a substitute for safeguarding insurance. And they do, while it is an extra layer of protection, it is fundamentally different than what the RPAA is trying to address. CDIC is guaranteeing that, there will be sufficient funds in those accounts that are held at banks, whether it's BMO or RBC, when those funds need to be drawn upon us, essentially providing a backstop in case of a run on the bank. The safeguarding legislation is more concerned with, are the funds that should be safeguarded, are they there in the first place? Is there proper safeguarding measures and policies put up? Because a guarantee, or if funds are not put into a trust in the first place, they can't be returned to end users. What the CDIC is trying to accomplish is to make sure that when we go to withdraw those funds, that they are in fact there at our bank account. So again, these are fundamentally different things. This is a question that we fielded quite a bit, and it bears it's useful to repeat that here.
And I'll just throw an addendum on my colleagues' comments, which are totally on point. I would just say the end user fund bond, the guarantee bond that we're talking about, is there to pay out in the event that the funds cannot be accessed post insolvency, right? So it's because the overarching concern for the regulator is that these funds become part of the now bankrupt company's bankruptcy estate and are only accessible to the creditors once of that bankrupt estate when paid out in priority. And the whole purpose of this portion of the legislation is to make sure that that doesn't happen, because those creditors shouldn't have access to those funds because they're not the companies, they're end user funds, and they're just being warehoused for a short period of time by the PSP. So that's the crux of the matter.
Oh, no, that's really helpful. I think we can maybe jump into the other type of RPA compliant option, which is trust. So I'm gonna defer to you, Simon. So what are the relative benefits, or rather limitations, of setting up a trust compared to securing a surety or an insurance product? How should PSPs kind of weigh their options when looking at their different approaches to safeguarding?
Right, trusts. Well, I mean, if you look at the RPA guidance, it says consult legal counsel. So we've been having a lot of discussion with a lot of PSPs about this, thanks to the free advertising from the Bank of Canada on that. But more seriously, a trust at a high level is really an ancient form of agreement, but it does have very particular requirements that it needs to have from a legal perspective in order to be an effective trust, and so it does seriously require consultation with legal counsel to get it set up. There's I won't go into the details. There's ancient rules of the 3 certainties that need to be in every trust. I know Sean, as the lawyer there, is nodding, and your memory of trust class on that. But that's the key point, and the goal of this is just the same as with the surety product that Cam and Sean were describing there, is to ensure that the funds are held in trust, which is to say they're not the funds of the payment services provider, they're the funds of the end user that the payment services provider is holding. And so what that means is there needs to be a kind of ring fence of the account in terms of funds can't be used to pay expenses of the trust. The funds need to be segregated. Of course, all funds need to be segregated, but it's particularly important with trust in this case. And there needs to be a trustee. And this is quite similar to what Cam and Sean were just saying about maybe the Bank of Canada guidance having some challenge in practice, because one of the things that, if you look at the Bank of Canada guidance, it says, well, the trustee can be the payment services provider itself, rather than a third party trust company, hiring a Computershare or BNY or one of the many trusts out there. We have some real concerns with that, with the PSP serving that role, at least from the provincial law that we've looked at. In the provinces that we've looked at, there are requirements that in order to hold funds in trust for the public, you need to be a registered trust company. So at least in the provinces that we practice law in, we have some real concerns about the ability of PSPs to act as their own trustee. So I would certainly suggest that if you're planning to do that, to be sure to consult with legal counsel on that point. Of course, you can retain a third-party trustee. That comes with a cost. And so that's maybe one of the advantages, or one of the disadvantages, I guess I should say, of the trust route, in terms of deciding which. There's obviously an expense at the front end in terms of setting up a trust, we're working with a number of payment services providers on setting up a trust arrangement right now. And it's very much a bespoke process in terms of getting the agreement right for their exact need. That obviously comes with a cost. Now, it may be, hopefully, that over time, as more of these are set up, we have, I don't want to say standard forms, but maybe accepted template agreements that have been used and reused, which will hopefully make the process of the trust route more cost effective over time. But in the meantime, there is a additional cost to that. In terms of advising PSPs on how to choose whether to go with a trust or a surety bond or otherwise, I mean, our advice would be, of course, to look at both. There's advantages and disadvantages that'll depend on your specific needs. One advantage of the trust is that the cost will, for the most part, not vary too much based on the size of the funds or the amount of funds. It's really, you're paying for the cost of structuring it. Whereas I don't want to steal the time of Cam and Sean, but I know that the cost may differ in those circumstances with a surety. I would also say, and maybe critically, that this isn't necessarily an either or. The Bank of Canada is explicit that, of course, you can have both, not on the same. It's probably duplicative to have them both at the same time, but there may be a business case to have certain funds subject to a trust and other funds subject to a surety bond, and that's certainly permitted under the guidance.
Oh, great. Yeah, thanks so much, Simon. And then on the other side, or rather the flip side, we also have the insurance products, the surety products. So what are the key reasons PSPs might choose an insurance or surety product rather than a trust? So I'm going to defer to our insurance experts.
Yeah, thanks for that. I totally agree with Simon. This isn't an either or, and we're not here to flog a product, right? There are going to be a myriad of instances where a trust is going to make the most sense. There's going to be some instances where a surety bond is going to make sense. And there's going to be some instances where a combination makes sense, right? Our focus and our objective in making sure that we have this product and we created a market for this product is so that those who are able to qualify for it have that option. We're not here to tell you that it's the be all and end all, and you never have to look at a trust or a letter of credit again or anything like that. It could work in a particular circumstance, and it's going to be an individual question for individual PSBs to figure out, and we're here to help provide some data on that as much as anything else. Having said that, we have gotten a little bit of feedback here and there. I think there probably are some quality of investments concerns that can be dealt with through the use of the surety bond rather than having the assets held in a trust. Again, that may be of interest to some people, that may not to others. We also understand that there could be tax implications of setting up trusts for end users. Again, we're not tax experts. We're not here to give that advice. That's Simon. That's the lawyers, right? But Cam, I think you might have a point or two.
No, yeah, I mean the tax and just again to echo these two, it's not at this point. PSPs are looking for a solution, so it is not a point we are in. The reason why Bennett, Jones, and Purell are sharing the call is that we realize that the solution that makes sense for that PSP is the one that they should go with. And having alternatives really is the benefit here. I think operationally too, that there's going to be some instances where setting up a trust is very easy. The other day we were talking with a PSP who had a very sort of concentrated number of clients, so that setting up a trust was relatively easy, and everything was virtual. Whereas we had another prospect, or a company that we were talking to, where it was far more bricks and mortar. There's operating ATMs essentially, and setting up an express trust through an ATM screen, where you basically have to execute an agreement, is just simply not feasible for their business model. So I think this legislation captures a vast array of types of businesses. It's not just the digital wallets. It's gift card providers. It's a lot of Forex, foreign exchange brokers. This is going to affect a lot of different businesses. So Sean and I are every day sort of surprised by the new and unique questions that we're getting from PSPs that are reaching out to us. So I think operationally, or operations will really determine the route that these PSPs choose. Again, we're not flogging a product. We're just here to provide guidance and hopefully find a solution.
No, that's great. It sounds like for PSPs, like the Bank of Canada has indicated in their guidance that there are different options, and it really just sounds like it depends on what might suit that company best, whether it's an insurance product, whether it's a trust account, or whether it's both. So definitely something PSPs need to start considering. That kind of takes us into our next question. So for PSPs that haven't started the safeguarding process yet, what is the advice on first steps? And I'm going to defer it to our lawyer, Simon.
Right. Well, act now is as the first piece of advice. September is coming fast, and actually one of the questions that I've heard a lot is, do you think the Bank of Canada is going to delay the deadline? And I've heard no indication whatsoever about any kind of delay from the Bank of Canada. So I think we should assume that September 8th is indeed a hard deadline, and proceed on that basis. In terms of the specific advice, well, as Cam and John and I have been saying, investigate all your options, because every business is going to be different on this point, both in terms of the surety and the trust point. I would say also that the framework process that's required, regardless of whether you do a trust account or excuse me, a trust or a surety insurance product, there's a lot to that. In terms of having the appropriate policies and structures and everything in place. So I would say that it's critical to get moving on that as well now. If you haven't already, you need to have the right person in place. You need to have a number of policies in place. And also critically for all of this, you need to have the right bank account in place. And I think everyone on this call knows well how difficult it can sadly be sometimes for payment services providers to open up bank accounts. So certainly don't wait on that. And then finally, also the liquidity solution is another one that is going to require really anything here that requires a third party to put in place. So most likely the liquidity, well, at least the liquidity arrangements, we're seeing a lot of lines of credit from banks and lenders, and obviously that'll take some time to put in place, particularly over the summer when sadly not all bankers move at the same speed that they do at other times of the year. So those are sort of the things that I would suggest to prioritize to get ready for compliance on September 8th.
Yeah, no, for sure. I think September 8th is approaching. It's sooner than we think. So definitely we need to kind of, for PSPs, I think a good advice is to kind of start the process, maybe consult legal counsel, look at your options and see what kind of makes the most sense for your business. So for companies that do want to consider maybe an insurance or surety option, what does the underwriting process typically involve? What should they be prepared to provide to an insurance company? So Cameron, maybe you can take this on.
Great question, Dana. You know what? I'll say this. I've mentioned it before through the call. Surety is a credit product. So naturally, those especially strong credits, the process can be very quick. If you're investment grade and other sort of flavors of surety, there are many companies out there seeking that type of business. So you can get sharp terms relatively quickly. Even comparison, another advantage relative to banking is that sureties can move a lot quicker. The agreements are more abbreviated. And again, when you place a bond, you can do so often without collateral. As far as what to provide, expect, the bare minimum is the financial statements of the applicant company, as well as any parent companies as well. But also, Simon touched on the actual safeguarding framework. Any surety company is going to want to look at that first, just to know that it's been sufficiently thought through and that it makes sense, because in essence they're also protecting their own interests in case of an insolvency event they'll be looking to collect. Other items include insurance policies, whether it's fidelity, cyber, just looking for risk mitigation strategies to prevent an insolvency in the first place. So but with that said, I really should emphasize that this is a credit product. So every surety is going to look at a potential PSP as an insolvency risk. And if the insolvency risk is little to zero, then you're going to be able to get sharp terms relatively quickly. If it's a more marginal case, expect 3 months. And again, no guarantee that a solution will be available. I intended, or I meant to sort of say this at the top when I was comparing insurance and surety, but it's useful to say here, companies purchase insurance, they qualify for a surety. So really liken it to, again, to a bank line where it's not a matter of just paying more. Many PSPs looking for a surety bond won't qualify essentially. And while I wish I could deliver some different news, that's just the reality here. But with that said, PRL, we pride ourselves, as Mert also touched on complex risks and finding solutions in tough situations. So don't let that dissuade you from reaching out to us after the call. We're always happy to have a conversation and try to find a solution.
Absolutely.
No, for sure. Thanks, Cameron. And then, Sean, I think one question a lot of people have is on the cost side, what are PSPs, what should PSPs expect? How much does pricing vary on company size or transaction volume?
Yeah, it's where the rubber hits the road, right? I mean, everybody wants to know what this costs. Again, I don't want to flog a dead horse here, but I just want to say the guarantee bond or even the insurance product that we're not comfortable with have very, very, very high underwriting requirements. So this is going to be a difficult product to obtain. You're going to need a good track record,
especially in the beginning.
Especially in the beginning when this is a novel product in the marketplace. You're going to need a good track record, profitability, or a very, very strong parent behind you, just from first principles. Now, what is it going to cost? Well, it's going to depend on what type of limits are being purchased. And as we all know from the RPAA and its regulation, that the PSP needs to set its limits, conservatively. It needs to look at the high watermark from a funds flow perspective and likely add a little bit of buffer onto that. So the amount that you have to purchase is going to vary company to company to company to company. And the cost is going to be a percentage of the limits that are purchased. So let's say your company A and your high watermark from a funds flow perspective is $40 million. Well, and you qualify for a guarantee bond. Depending on the strength of your risk, you're going to be purchasing $40 million at a percentage of those limits, which is likely to be somewhere in the area of 75 to 300 basis points. So 0.75% of the limits that are being purchased up to, say, 3% of the limits purchased. And I would say that if the pricing were to go above 300 basis points, you're probably not going to be qualifying anyways. And this would be very, very strong risks that are even falling within this very large range, because 0.75% of limits purchased is a big difference, when we're talking about purchasing millions and millions of dollars worth of limits between 3%, right? So that is how the pricing is organized, and that would be paid on an annual basis. So these would be organized as annual bonds, just like an insurance policy is 12 months. So this would be an annual cost. And one question that we do have come up over and over again is, can we change the limits midterm? And the answer is yes, but it's not a floating limit. So you will have to choose an amount, and it could be amended, but it's not going to be something that we'll be able to amend on a daily or weekly or even monthly basis. Like you might be able to adjust it, say every quarter or something like that. Or if there's an event upcoming where you know you're going to see a spike, you can amend it, but you'll have bought those limits for the rest of the term on a pro rata basis. It won't be something that you can just adjust up and adjust down as needed. Fair, Cam?
Very fair, very fair.
No, I think that's really helpful. I don't know if there's too much information out there in the market, so that's definitely helpful for PSPs to know. Okay, great. So thank you, everyone. That's kind of our panel discussion. So we're gonna open it up now to audience questions.
I think that Josh, I'll touch on his question real quick. So we have been, well, first, thank you for the question, Josh. Great question. I'm glad that someone in the audience asked this. We have been engaged with the Bank of Canada directly for about 18 months now. And at the beginning of that engagement, they stated and maintained that they will not approve any form, but they expect the industry to come up with a suitable form that does meet the requirements of the RPAA. So while we have not had and will not receive, because they insist on doing so, that we will not receive explicit approval that the form will be accepted, this is something that has been in front of them for months and months now, and we've been able to incorporate feedback over those months and months. So do we have explicit approval? No, that was never going to be delivered. Are we comfortable and confident? Yes. But again, for all the reasons that Sean said, again, this is, we are kind of, the product does kind of thread the needle between those who might have operational reasons, but then also qualify. So really the issue here is not the form, but it's just, the applicant themselves. But yeah, no, great question, Josh. I will say that, expand on the payout of the surety. Yeah, great question, Josh. And,
Can I handle that?
please go ahead. We got another question.
I just want to talk. I'm a former litigator and I just love talking. Just to end, just to build on Cam's statement, and to further answer Josh's question, the product itself, especially when we're talking about the surety bond, is very, very simple. It's, the requirements in the act are not complicated. The trigger is insolvency. The payout must be as soon as possible, and it must go to the benefit of end users and only to the benefit of end users. And from a drafting perspective, that's awfully easy to accomplish. So again, when we say we're quite confident in the form, we're quite confident in the form because it's quite easy to get, right?
Yeah.
Now that segues almost perfectly into the next question, and you might even say I set it up that way. But so how is the bond to be paid out? So insolvency occurs, and there will be a bankruptcy estate established. And Simon, you can come on in and tell me I'm way off base on this, but this is how it's been imagined on the bond form.
Yep.
And end users will essentially make a claim to the trustee in bankruptcy to show that they had funds in the segregated account at issue that they can no longer access because insolvency has occurred. And this will be in, our hypothetical minds lined up with the ledger that Simon had just talked about, right? So the ledger will be lined up against the claim of the end users, and they will essentially prove that they had funds in the account at the time of insolvency, which almost acts as an iron curtain descending on all of the operations of the PSP. So it freezes everything in time. And at that point, the claim will be submitted by the bankruptcy trustee to the bond company on behalf of the users, and the surety, the bond company, will then pay out the funds either into a predetermined trust fund for the benefit of end users, or a trust fund will be established for the benefit of end users, and the funds will be paid into that account. Again, the PSP, the now insolvent PSP, and its creditors will have no claim to the funds that are being paid by the surety into that account, and then the surety will then go try to recoup what it's just paid out as a guarantee bond.
And for simplicity's sake, the bond form that we've created identifies the segregated account at the beginning. So just to sort of make things abundantly clear, we know sort of the landing spot for any potential claim before the claim or the insolvency actually takes place. A lot of this too really marries with the safeguarding framework that PSPs are asked to develop or are mandated to develop. So a lot, you can kind of lean on that framework that's divided to understand how a claim would work or would take place. But again, really just to make things abundantly clear, a specific account is identified on the execution of a bond, just to make things that much more simple. And sorry, Simon, did you want to jump in?
No, that's all. It's all agreed with all that. And the framework, in terms of getting the end users, to add to what Sean was saying, it may well be a claim from the end user. But one of the components of the ledger is that it needs to have the contact details for all end users. And the reason for that is that the trustee will need to be able to contact all of them to ensure that the requirements under the act, that the funds make their way to end users as promptly as possible is
yeah, that's right. And there's in the guidelines too, there's sort of mandates that the trustee will have access to the wording, the amount of the bond that changes over a specific time. So the Bank of Canada did sort of contemplate, okay, when the proverbial you know what hits the fan, how can the trustee execute on their responsibilities in order to make a successful claim on the bond and to direct the funds into the right place.
But what we know for a certainty is that the Bank of Canada will not be administering claims.
Yeah, yes.
Correct.
They've been very clear about that. Yeah, they're not trying to take any business away from, your PwCs of the world or, an insolvency administrator. That's going to be handled by third parties.
But they do ensure compliance with the act generally. So if you are not registered, if your compliance is deficient, you should expect to hear from the Bank of Canada.
Yeah. And anyone? I hope that answers your question. Does anyone else have any parting, or we'll give everyone a few more seconds to punch in their questions here.
Not to take more time, but if people don't have questions, I could talk about a couple of questions that we do get from a lot of our clients, but I don't want to explore from anyone.
Did anyone specifically have any questions? If you want, you don't need to type it. You can also just unmute yourself. But maybe let's just give it a few seconds.
I did want to ask, with surety bonds, is it fair for us to expect that you'd probably only be able to get a surety bond to a certain limit? So, like...
Oh, sorry, finish your thought.
No, I appreciate how you were saying, like, you can only really adjust a surety bond probably once a quarter, if not even less frequently than that. So you'd probably want to account for a lot of buffer. And I'm just wondering, I guess the issuance of a surety bond, I guess it really depends on the company putting that bond together. But in is it your expectation, like probably anything over 500 million or anything over 1 billion CAD, that's going to be like pretty rare to find?
Yeah, and that would be definitely on one end of the spectrum. That's definitely a large number. But what I will say, and this is a novel product for other sort of types of surety bonds. One area that PRL focuses on a lot is mining. And it is not uncommon to find reclamation bond facilities north of $2 billion. So it is not something that the surety industry is completely unfamiliar with. What I will say is that because this is sort of a newer product, sureties are going to be cautious and conservative. And if something in that neighborhood, Josh, is required, you can expect to have multiple sureties participating on one bond program. So perhaps we don't place all of the exposure with one insurer, but you split it up amongst 5. And that's what we do with other types of surety bonds. So, you know what, for the right credit too, it's really just comes down to terms and if it's commercially makes sense, because if we're frankly, you know, not to pick on someone, but if we're talking about PayPal, I think a lot of sureties there will be eager to write their business. And I imagine that, you know, with the digital wallet business, that their safeguarded end user funds, and even in Canada alone, will be something in that realm. So my answer is never say never. And for the right client, a solution can be made. There aren't going to be any hard ceilings on this. But, you know, sureties are going to approach this cautiously. So I hope that answers your question.
I've got a quick question. It's Jerry. I was involved in winding up a company that we acquired in Salt Lake City, and there were a lot of dormant accounts in the overall. So when you look at the overall value of the funds, do you assume that a certain percentage will be dormant and those don't need to be covered, or you actually have to cover the entire portfolio?
So,
I'm happy to
sorry.
jump in on that. Yeah.
So Jerry, in terms of the funds that are required to be segregated, it would really be any end user funds that are held. That's the key term. So I know this isn't what you're asking, but funds that are in transit are not required to be subject to this. In terms of you know, dormant, I think it would really depend on what that meant. But if the funds are still being held on behalf of an end user and still waiting for instructions from that end user, I would say that there isn't a like a sunset period set out in what.
Yeah, in this case, we had to obviously transfer a lot of funds to the state. Same in Canada, you know, funds that are dormant for a certain period of time get transferred out of the account to the bank, and there's a database you can look up. But typically, those funds aren't touched for a certain period of time. Let's say 90 days or 6 months or whatever the period is, and we assign them as dormant.
Yeah. Well, you would have the, you know, I would say as part of the framework and part of the plan for insolvency, part of that may be to you know, ensure that all of the end users are contacted, right? And you would have end user contact details. Now, if you know, if no one responds, then it you know, the act isn't this specific. But our expectation would be that it would be analogous to what you described for bank accounts, that they would be held otherwise.
Now, if part of your business is sponsored by a bank, and that bank actually holds the funds, you don't. Do you need a letter from the bank saying that they agree to their own guidelines and you don't? You're basically covered because the funds are actually held by the bank and organized by the bank, and you don't actually hold any customer funds for whatever business it might be.
Yeah, that's a great question, Jerry. That was actually one of the ones that I get asked a lot, which is, you know, part of it is, you know, if you've got a bank performing these services for you, are you off the hook on compliance? I know that's part of your question. The short answer is no, because even if you have a third party performing any responsibilities for you, you're still, as the PSP, responsible for ensuring compliance. Now, if the bank is the one that's acting like as the effectively acting as the PSP here, that may be different. But if it's simply the case that the funds are in a bank account and the bank is performing a role, but you know, the PSP is still running the business, I would say that the PSP is still responsible for ensuring compliance. Does that answer your question?
Yeah, I think so. But again, the bank has insurance as well on funds. So we'd have to look at, I don't want to pay double basically for the insurance and the funds that the bank's maintaining, plus reserves, plus what we may have to maintain.
Totally. I mean, the bank insurance, though, like the CDIC insurance is for insolvency of the bank rather than insolvency of the PSP. So it, hopefully it can be structured in a way that avoids that duplication, but it'll depend on the individual.
I think that this is, and it's something that through the act, the regulations and the guidance has been touched on a little bit, is I believe that this is described as an indirect arrangement where they're not holding on, you're using a third-party vendor or a bank to actually warehouse the funds. But Jerry, the emphasis here is, okay, what happens if a PSP receives end user funds and it never makes it to the bank, or they've withdrawn them erroneously to make payment, expenses to pay employees. They've done something that under the act is not allowed. So while the funds, yes, in the bank are safeguarded or insured against a run on the bank or a liquidity event, the emphasis here again is on the correct safeguarding of the funds in the first place. So if they never make it to the bank account, those are still at risk. So while there is, you could argue that they are kind of being double insured, that in this case is kind of the intention of the act. It's a feature, not a bug, to use technology.
Well, I'd actually want to jump in for a second and just say, the intent of the insurance or guarantee over the funds as required under the act is purely and only with respect to an insolvency risk.
Mm-hmm.
It is not, the bond that we're talking about is not there to step in if somebody were to steal the funds from the segregated.
But it could, though.
It
could.
It could
Yeah.
if there's an insolvency trigger.
Right.
Right.
Yeah.
So
it's not a fidelity bond.
It's not a fidelity bond.
Yeah.
That's a different type of protection that it can be covered by things that are already in the market. That's a fidelity bond. That's a crime policy. There's different areas of insurance for that, but that's not what the end user safeguarding protection framework is calling for with respect to this bond or insurance.
Yeah.
Right? It's calling for protection of these end user funds in the event of insolvency to make sure that the end users don't lose their funds to the bankrupt estate.
Yeah.
It is for that purpose and that purpose.
Essentially, if they go insolvent and in the segregated account they have 5 million, but it should be 7 million. That is what we're protecting here. So even though that 5 million is guaranteed, still 2 million short. Oh, sorry, Jerry, you're muted.
Thank you. Yeah, typically we'll have a fee account and obviously a client funds account that we don't touch. So, and the fees are obviously a small percentage of the client funds, typically based on transactions and other things. So typically we'll never ever touch client funds, other than to ensure that fee payments are made. So I guess in terms of the surety bond, it'll cover the entire amount when it triggers insolvency. But if there are any fees owing or paid, do those come out of the customer funds if there's anything outstanding?
That is a good question. My initial answer would probably be no, but you know what, Jerry, let's take that one offline, because that is one that's a question I've heard for the first time. So yeah, let's definitely exchange contacts and talk about that, because that's a good question.
Thank you, guys.
Yeah, and Jerry, just to answer that question, if it were a trust, the guidance is the best practice is what they said, and for the trust is that the trust fees not be taken out of the account, that they be separate.
Yeah, I'm not thinking of trust fees. Yeah, I'm thinking of actual, there's a monthly account fee. Let's say it's $5. And, you have 100,000 customers and it's $5 and you go insolvent, but the last month or the last 2 months of fees are still owed, kind of thing. Where does that come from?
Good question.
I would defer to a bankruptcy lawyer on that one and the mechanics of whether or not that portion of the funds would flow into the bankruptcy estate and then be distributed to the benefit of creditors and borrowers. But from my perspective, we're getting into the weeds on something that's like, we're just here to give you a bond. I think Simon and his team could drill down on that.
Yeah, no, that's fair.
Yeah, it would really. Sorry, Jerry, go on.
I was just going to say, in the U.S., when we took over this company and we basically made them go bankrupt and picked up the assets, we actually took the fees that were owed before paying out the clients, working with the bank. And it actually took almost 6 months to pay out every single client, to track them down, find them, and pay them the funds. It was not an easy thing. So
Yeah. Certainly if you keep the funds for the fees separate, you're safe. In terms of using the fees to come out of user funds, I would say that starts to be a little riskier, and you want to get specific legal advice on that, depending on the.
yeah, no, I'm just saying that it's good to keep excellent records and people's addresses change a lot, but the challenge is to get them paid can take some time and it's expensive.
Great. Is there anyone else who has any questions? Okay. Any last questions? We have 1 more minute. If not, I think we can.
Maybe we'll just say that the conversation doesn't have to end here. Simon is available, Sean is available, I'm available, heck, even Mert's available. We can continue this conversation and answer your questions after the fact. Donna will make our contacts available to those who have joined the webinar, and like we said earlier, September 8th, it's upon us. It feels like it's next week. Because these things are complex, and I know that each of you are doing your best to make sure that you're going to be in compliance ahead of that date. So we understand your sort of the task in front of you, the struggle, and we are here to assist. So I think we give everyone their 2 minutes back and just say that we are available to help.
Yeah. Thank you, everyone. Thanks to our panelists for sharing their expertise today, and thanks to everyone for joining and participating. Like Cameron mentioned, we will be sending out an email following this that will have the contact information of all the panelists that spoke today. So if you have any questions, feel free to email them directly. Or you can email us as well, and we'd be happy to direct you to them accordingly.
Thank you so much for organizing this, Dana. This was great.
Bye.
Thank you.
All right. Thanks, everyone.
Thank you.